Hello and welcome. Here we're going to discuss case studies on various uh, somewhat overlooked. Keep in mind there are thousands and thousands and thousands of doctors, law firms, and accounting firms and small business owners across the country. Only about 11,000 of them have taken advantage of the items that we're going to portray for you um, here in these retirement plan case studies. It's important to realize that these items are relatively unique and require a lot of oversight. They're not cookie cutter plans. They're specifically designed around medical practices, doctors who own their practices, whether it's a single doctor or multiple owners, small business owners, law firms, accounting firms. In any event, whenever you talk about tax laws and qualified plans, clients and practitioners often become uneasy each time there's a change in the tax laws. And of course, these days with DC, that could be any time. One might think that changes would hurt business or the plan's capacity to continue. We found that's really not the case. We see it another way. When tax laws are stagnant and there's no change, odds are less innovative firms will capture business and clients will not get the best advantages they may have in coming to them. But when things change frequently, only the innovative firms tend to survive, and that's when clients are served the best. In this team's 33 years in this business designing plans from an actuarial perspective, there's never really been a stagnant time. So clients are really getting the best that the laws have to offer. So let's review a recent example. CPA firm provided information about a medical practice and asked if there was anything that could be done to improve the plan. It's a single owner of a plastic surgeon firm with 27 non-owner employees. The owner is very successful, earns in excess of $1.2 million, but we can only consider $255,000 for purposes of plan design. Total compensation for all the other employees is about $795,000. What's worse is the owner is only 52 years old and his employees range in age. It's not a great scenario to create perfect balances within, but create we will. The client currently had a cross-tested Safe Harbor 401k profit-sharing plan, and the services were provided by one of the better firms, actuarial firms in Chicago. Total plan assets are approximately $5 million and about $130,000 of annual contribution. Based on the current plan design, the owner receives a total allocation of that distribution or that contribution of $55,500 between profit sharing and salary deferral. The corporate cost for all employees is a rather heavily weighted $35,000 plus dollars. So we have a high quality actuarial firm, an employer who earns in excess of $1.2 million, slightly less than desirable employee demographics for testing purposes and design purposes, and an owner who spends a very overweighted $35,000 on his employees to receive just $55,000 for himself. Our view for the owner and the CPA was that the actuarial firm in question was not being as effective as they possibly could be for the client, and it was time to wake everybody up. So here we go on to plan design. First, we made some changes to their current plan. At first blush, they may seem rather odd, but we increase the $35,000 the corporation is currently spending on employees to $41,000. Then we reduce what the owner receives from 55 to 41. Don't get too excited yet. Then we're able to overlay a cash balance plan with total non-owner employee cost of just $15,000. We can then maximize our owner and get his cash balance contribution up to the limit of $162,000, or nearly an 11-to-1 ratio. I know this all sounds simple, but when you see the end result, the numbers and the levels of complexity here that most firms simply avoid or sometimes don't even understand. Now, there's a reason for that. There's lots of reporting required each year, and the IRS and Department of Labor to require you to live up to various guidelines because these benefits can be so significant. Nevertheless, all testing and plan designs receive IRS approval and favorable determination letters long before any plan is implemented. So these are not aggressive. There's nothing in here that's aggressive. This is just solid and intelligent pension actuarial design. Specific plan designs are centered around client needs, and it's what will separate them from the average services received by too many that really do require these higher end plans. So the end result is as follows. Remember the previous plan. The owner's total tax deductible contribution was $55,500. The corporate tax deductible cost for employees for that contribution for the owner was $35,445. Under the new structured plan, the owner's total tax deductible contribution will now exceed $200,000, saving over $100,000 in corporate taxes currently being spent either personally or corporately. Corporate tax deductible cost of employees does go up slightly to $56,000. The summary would have you seeing an increase of $21,000 pre-tax, or just a little over $11,000 after tax, in return for increasing the owner's contribution by $148,000. Think about that for a second. Half of that $148,000 was already being spent. Now all of it is going into tax-deferred contribution and tax-deferred growth in the owner's retirement plan. As a last note for the clients on this type of consideration, the owner is contributing at the rate of 80% of compensation, and his wife is the same age as he is. If she, for example, were to become a bookkeeper for the practice and earn $35,000 per year, she can then also receive $23,000 in pre-tax salary deferral, $2,100 in profit sharing, and an extra $22,000 in the new cash balance overlay contribution for a whopping $47,000 of tax-deferred benefits in her retirement structure, which is 135% of her salary. And this can all be added so that the total owner's family will now receive over $250,000 with no additional cost for employees on that last portion for his wife. So think about it. This is an example of very specific design around a very specific successful doctor's practice. For a confidential review about your goals, if you find yourself in this situation and are not able to attain those types of contributions, it's time we sit down and talk. Let's grab your lawyer, your accountant, and yourself, and let's sit down and review these issues and see if your goals can be designed this way. Feel free to call us at 312-957-2400 or visit us on the web at www.genesisam.com. Feel free to send us an email at info@genesisam.com. We want to thank you again for your time. We know you're quite busy. We appreciate your time with us, and we hope this information has been helpful. Thank you very much.